Whether your account is negative by $4 or $400, the exact amount often matters little. The system's response doesn't scale with the severity, it simply activates. An overdraft fee, typically $35 at most institutions, is charged within hours. Some banks even apply this fee per transaction. This means if 3 small purchases are processed while your account is negative, you could incur $105 in fees in addition to your initial deficit. The financial logic here is almost elegantly punitive. If you had money, you wouldn't be overdrawn. But precisely because you don't, you now have even less. Imagine trying to pay at a gas station. Your debit card declines. You try again, it declines again. A line forms behind you. You frantically do mental math, unable to process it fast enough while your card keeps declining and everyone watches. This is the tangible feeling of financial stress, not dramatic or cinematic, but the simple anxiety of a card declining as you second-guess yesterday's transfers. Banks often offer overdraft protection. In practice, this means they'll cover your transaction instead of declining it, charging you another $35 for the service of avoiding embarrassment at the gas station. While some banks, under regulatory pressure, have reduced or eliminated these fees, most have not. The remaining fees disproportionately impact those who can least afford them.
In a single recent year, banks collected over $7 billion in overdraft fees. The majority came from a small percentage of chronically overdrawn accounts, the same individuals repeatedly paying for the perceived privilege of poverty within a system designed to charge for it. At this level, you can't get a credit card, a loan, flexibility, patience, or a helpful phone call. What you get is an automated fee, levied by a system that doesn't know your name, doesn't know your paycheck was delayed, and doesn't care that the $47 charge was a forgotten gym membership. The system knows only one thing: your balance is negative. Everything else stems from that. You are not a customer, you are a cost the bank aims to recover. You've managed to bring your account out of the negative, perhaps hovering around $200, $400, or occasionally $600 before rent drains it again. You're no longer overdrawn, but you're in a category the bank services without particularly valuing. Then comes the monthly maintenance fee, $12 or $15, automatically withdrawn because your average daily balance didn't meet the minimum requirement, often $1,500, sometimes $500. If you had that untouched $1,500, the fee would vanish, but because you don't, you pay for the very account holding your money.
This is a basic checking or savings account, offering no special rates because your balance is too low for tiered benefits. You earn a negligible 0.01% annually on your deposits, while the bank lends that same money out at 7% to 24%, depending on the product. This spread between what they pay you and what they earn is fundamental to banking at every level. At this level, your business simply isn't significant enough for banks to actively compete for it. If you try to apply for a credit card, you might only qualify for a secured card. This requires you to deposit your own money as collateral, essentially lending the bank funds so they can lend them back to you, charging interest for the privilege. This is legal, normal, and how credit is built when you're starting at the bottom of the financial tier system. The service you receive isn't hostile, it's simply indifferent. The teller is polite, the app functions, and if you call with an issue, you'll wait on hold, eventually speaking to someone reading from a script. They can solve standard problems and escalate complex ones to an unseen higher authority. There's no relationship here, only a transaction. You need basic banking services, and they provide them. That's the extent of it.
At this level, you are merely a number, a small number, and the bank's interest in small numbers is purely automated. Something shifts, not dramatically, but noticeably. You land a steady job, or your current one starts paying better. Your direct deposit is now a consistent $3,200 a month, hitting every 2 weeks without fail. The bank notices this, not with a call or congratulations, but algorithmically. Your account's pattern transforms from irregular and low to consistent and moderate, and the system categorizes you differently. Soon, credit card offers begin to arrive. Not secured cards, but actual credit cards with limits of $2,000 or $3,500. Interest rates remain high, around 22% to 26%, reflecting your shorter credit history and the bank's risk assessment. But the door is now open. The institution that ignored you 6 months ago now sends mailers and displays banners within their app pitching products you previously couldn't access. Your consistent income has made you a viable revenue source. You apply for a small personal loan, say $5,000 for a car repair. It's approved in 48 hours, not lightning fast, but functional. The 11% interest rate isn't ideal, but it's manageable. What truly stands out is that the process worked. For the first time, you needed something, applied, and were approved. The bank functioned as it's portrayed in popular narratives.
Your monthly fees have likely disappeared, as your direct deposit now qualifies you for a waiver. This small change feels significant precisely because you paid those fees for so long. Your account now costs nothing to maintain. You're simply keeping your own money without paying for the privilege. You are now a recognized, serviceable customer. The bank wants to retain you because you generate revenue through card usage, loan interest, and your growing balance, which they lend out for profit. You matter to them in the way any customer matters to a business, as long as you're contributing, but replaceable without ceremony if you leave. You've been consistent, not lucky, not dramatic, just consistent. Your savings account holds $18,000, your investment account another $22,000. Your credit card is paid off monthly, rendering the 24% interest rate irrelevant as you never carry a balance. Through ordinary discipline over several ordinary years, you've built a financial profile that looks meaningfully different to a bank's risk models than it did 5 years ago. Credit limit increases begin to happen automatically. You log into your app and see your limit jump from $4,000 to $9,500, then to $14,000. The bank extends you more rope because your history proves you don't need it. You pay on time, don't max out. You are a low-risk, high-engagement customer, and the bank responds by offering you more of what you've proven you can handle. When you buy a car this time, your loan rates are significantly better. The bank offers 6.8% instead of 11%. This isn't personal preference, it's because your credit score and asset profile have shifted the risk calculation in your favor. The price of money is lower for you because you've demonstrated that lending to you is safe. This is how wealth compounds within the banking system, even before it becomes substantial. Better rates mean you pay less for the same things. Paying less means more capital remains in your hands. More capital builds faster. The system slowly, quietly begins to tilt in your favor at the level of basis points and approval rates. You are becoming valuable to the institution. Not precious, not a top priority, but valuable enough that they prefer to keep you and would offer slightly better terms to do so. If you were to walk into a branch and mention moving your accounts, someone would likely try to retain you with an offer. This is a distinct experience from the automated indifference of Level 2. It's not intimacy, but it's the beginning of leverage.
Your combined assets, including savings, investments, and perhaps a burgeoning retirement account, now exceed $150,000. Though not rich by the standards we'll discuss later, you are in the top tier of what most retail banks encounter daily, and the treatment reflects this. The phone line is now different. A priority queue exists for customers at your asset level, meaning shorter hold times and more senior representatives. They have greater authority to waive fees, make exceptions, and approve requests without escalation. When problems arise, and they inevitably do, resolution is faster and more satisfying because the person handling it has the tools to resolve it directly.
At some institutions, particularly the better banks, a dedicated banker may be assigned. This is where a named contact emerges, someone who knows your account, emails you directly, and calls to check in. It feels like a relationship, and in some ways it is, though it operates within a commercial framework. They are attentive because their performance is partly measured by the retention of accounts at your level. Understanding this commercial motivation doesn't diminish the usefulness of the real access you gain. Pre-approved products begin to arrive. Mortgage pre-qualifications, investment opportunities, and premium credit cards offering substantial rewards, far beyond the 1% cash back of lower-tier cards.
The institution is now competing for your future business, not just your current balance. They consider your potential and price their offerings accordingly. You are a preferred client, named, known, and flagged in the system as someone worth protecting. The definition varies by institution, but high net worth generally starts between $500,000 and $1 million in investable assets. At this level, the bank transforms from a place you visit into a service that comes to you. Wealth management is offered, a packaged service combining financial planning, investment advisory, tax coordination, and estate planning guidance into a single relationship. Quality varies significantly by institution and advisor. Some are exceptional, others are expensive salesmen in good suits. You quickly learn the difference as it impacts your finances. Conversations shift. You're no longer being sold consumer products, you're being consulted. Someone asks about your goals, timeline, risk tolerance, and family situation. The bank aims to understand your full financial picture, not out of altruism, but because it enables them to offer a broader range of products and capture more of your financial life under their umbrella. The motivation is commercial, but the experience is personalized. Both are true simultaneously. Loan approvals are faster, paperwork lighter, rates better.
If you call about a problematic wire transfer or a fraud alert freezing an account you need immediate access to, the issue is resolved in the same conversation. No callbacks, no escalations, no scripts. Someone with actual authority handles it in real time because your account warrants that level of response. You are now an asset to the bank, not merely a customer, an asset. Internal system language, protocols, and the overall experience are all different. The gap between this and level 2 isn't just better service, it's practically a different institution operating within the same building. With assets exceeding $5 million, the bank starts offering products not publicly advertised, rates not posted online, and access to investments unavailable to retail customers. These require accredited investor status, significant minimum commitments, or a relationship history that most people simply don't possess. Your mortgage interest rate is meaningfully lower than anything offered at level 3, not slightly, but by tens of thousands of dollars over the life of the loan. The bank competes aggressively for your mortgage because a borrower with your profile presents almost no risk, and the relationship promises valuable ancillary business across various products. At this level, your advisor is not a generalist but a specialist, possibly even a team of specialists. One for investments, one for tax strategy, and another for estate and trust structures. They coordinate, communicate, and meet with you quarterly in a room distinctly unlike the waiting areas for Level 2 customers. Better chairs, different stakes. You receive special treatment at this level. While that phrase sounds simple, it means the rules governing retail banking, the minimums, waiting periods, approval timelines, fee structures, and access restrictions are applied differently to you. Not because the laws are different, but because the bank's internal policies include discretion, and that discretion is exercised in favor of accounts generating significant revenue. Private banking is distinct from wealth management, much like a charter flight differs from first class. Both get you to your destination, but the experience is incomparable.
At this level, you don't merely have a banker, you have a private banker, a title with a specific institutional meaning. This individual manages a select number of relationships, sometimes fewer than 20, and their entire professional focus is on these clients. They know your children's names, your foundation, what you aim to build and protect. They possess direct access to institutional decision-makers who can craft bespoke arrangements beyond any standard product menu.
Deals at this level are bespoke. Loan interest rates are negotiated, not published. Investment minimums for private equity co-investments are waived because the relationship justifies it. Documentation for a transaction that would take a retail customer weeks to complete is handled internally in 48 hours because those processing it understand whose account it is. The rules become flexible. This statement requires honesty. Banks do not break laws for wealthy clients. Instead, they exercise every legal degree of discretion available within their policies, always in favor of clients whose relationships are worth preserving. Fees that technically apply are routinely waived, often without being asked. Exceptions requiring manager approval are granted even before the manager is formally consulted. The system, automated and indifferent at level 1, is now human, attentive, and oriented towards yes. At this level, you are not a client, you are a relationship. The institution's relationship with you is a named line item in someone's performance review. Losing you would matter deeply to individuals whose careers depend on retaining you. This represents a distinct kind of power, unlike anything else discussed.